In this video, I'm going to answer the question, is SoFi stock a buy? I'm going to use my simplified 6-step framework to answer that question. So let's get right into it. The first step in my framework looks at customer value, and SoFi offers a convenient lending platform with higher approval rates, lower APRs, faster processing, and digital banking just works better than traditional brick and mortar banks. It's just so much more convenient. You don't have to deal with the branch. You don't have to spend all that time with documents, signing paperwork, and all of that stuff. Is just faster, offers customers more time savings value there. And looking at SoFi's customer growth, you can see that there's evidence that yes, people are preferring to bank in this new way, right? 4.3 million members as of the second quarter of 2022. That's up from just 759,000 in the second quarter of 2019. Another item I like to look at when determining customer value is the Net Promoter Score. So this is just a survey that asks people, how likely are you to recommend this company to a friend? And this measures, how satisfied people are. And it's a whole, process and calculation. But so SoFi has a Net Promoter Score of 24. And here's the scale that answers what's a good Net Promoter Score. So with 24, SoFi has a good promoter score. It's almost, it's close to having a great promoter score, which is from 30 to 70. But for now, it just has a good net promoter score. The next step in my framework considers unit economics, and a digital lending platform or a digital bank has the potential to operate at lower cost than the traditional banks, which already generate high profits, right? They already generate healthy profits. And now you have a digital version of a bank which could potentially, at scale, earn higher profits than traditional banks because you don't need to have all those branches, you don't need to have all those employees, and operating costs are reduced. However, until it reaches that scale, SoFi is still generating massive losses on the bottom line. Net losses of 224 million in 2020, which more than doubled to 484 million in 2021. The next step in my framework looks at the total addressable market, which it has a $6 trillion opportunity ahead, including 4.2 trillion in lending of mortgages, 770 billion in auto loans, and 640 billion in small business lending. A massive market opportunity. The next step in my framework looks at competition, and SoFi is not alone in the online banking, online lending industry with competitors that include Upstart, and it also is competing against traditional lending institutions like the Bank of America, like a JP Morgan Chase, that still capture the lion's share of the loan and banking market. And there is a hesitancy to move away from those historical credit scoring methods, those historical banking methods. And so even though SoFi is growing, it's finding it difficult to grow as quickly because there's still friction between itself and those historical traditional banking companies. The next step in my framework looks at valuation and looking at SoFi's price to sales ratio because it's not profitable on the bottom line. It's not generating consistent free cash flows. So I chose to use the price to sales ratio. And at 3.3, it's near the lower end of its historical price, even though there's only about a year and a half of history in pricing information for SoFi. The price to sales of 3.3 is near the lowest it's been. So you can say that it's relatively inexpensive. Finally, the final step in my framework looks at the risks, and recessionary forces could cause a decrease in loan demand as well as an increase in defaults on existing loans, and that would be bad news for SoFi. And then secondly, I note business model risk of a yet unproven lending model due to its relatively short history in existence. It hasn't been through multiple recessions and times when consumers face difficulty and they don't pay back their loans. And so we don't know how SoFi's loans are going to perform in those types of down markets. So that's a risk for investors going forward. All right, now that I've looked at each step in the framework, let's give it a grade. For customer value, I gave SoFi a B+, right? Adding convenience over traditional methods. Digital banking, digital lending is just more convenient, time saving. Customers are showing that they like it. A good net promoter score. So all of that gets them the B+ score. Unit economics, I gave them a B here because of the losses on the bottom line. They haven't yet achieved the scale to show how profitable they could be. And so just a B here. Total addressable market, they get an A+, right? Massive market opportunity in the trillions. Competition, I gave them a B. It's going to be difficult for them to attract a mass of customers from those traditional banks, and it's going to take a lot of marketing. It's going to take a lot of explaining, convincing, and engagement to get those customers to come over and try them out and ultimately stick with them. And so for risks, I gave them a C here. Going into a recession with an unproven business model, we don't know how far those defaults are going to go, how deep they're going to be, and they're still losing money on the bottom line. So for that, they get a C. Valuation, I gave them a B- because even though it's relatively inexpensive, I had to use the price to sales ratio, which is not as informative as looking at the price to earnings or price to free cash flow, as well as I didn't have a long enough history of data for SoFi because it's such a young, it's brief history as a public company. So B- in this regard. All right, so before I move on to the next slide, which will answer the question of is SoFi stock a buy right now, this is where I would like to recommend for you to subscribe to my channel because I will be offering updates to SoFi as the business evolves, as the business changes, as it reports earnings, and the valuation changes. So this recommendation I'm going to give is not a static value. It's not a static recommendation. It's going to change over the next few weeks, over the next few months. So if you're subscribed to the channel, you're going to get those updates. You're going to know when the recommendation changes, and so you're going to be able to make a more informed decision. So please go ahead and subscribe. Okay, so that being said, is SoFi stock a buy? SoFi stock is not a buy. Not a buy. The losses on the bottom line combined with the yet unproven business model and its relatively young history sways me to say the stock is not yet a buy. I want to see more information, more data on how its loan portfolio performs as the economy enters or contracts a little bit, or I also would like to see the valuation drop even further to then provide a better entry point with a larger margin of safety before I would feel comfortable recommending this stock as a buy. All right, so that's all I've got for SoFi. Thank you for watching, and I'll see you next time in the next installment of Is This Stock a Buy? I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.